What's up, crypto crew? DeFi Dan here, coming to you from DC Extra. Today, I want to talk to you about the top 5 mistakes that I see from brand new crypto traders all the time. And hopefully, by bringing these to your attention, when you begin your crypto trading journey, you'll be able to avoid them and become a much more successful trader right from the beginning. So, the number one mistake that I see from brand new crypto traders is being impatient. They're rushing into trades, they want to make money yesterday, and they aren't willing to put in the work to learn how to be able to analyze the charts properly and to be able to make informed decisions. And this generally manifests itself in the way of FOMO, or fear of missing out. And it's really common as a beginner. So when you first start, you're looking at all these price charts and not really sure what to make of them, and definitely not sure how to analyze them. And so quite often we can make impatient decisions and rush into trades, not necessarily knowing exactly why. And doing this is a surefire way to lose money, because more often than not, we make the mistake, we rush in too early, we buy at the wrong time, and then prices turn around and come back down, resulting in us losing money. So managing your patience and making sure that we never FOMO into a trade is the number one thing that we want to get on top of as a brand new trader in crypto. Second most common mistake that I see from beginner crypto traders is trading too much of their account, or over margining and over leveraging their account. So when we trade futures contracts, we have an option of how much percentage of our total account we want to put into a trade. And the higher the percentage, the higher the reward, but also the higher the risk. So personally, I recommend that all new traders only ever leverage 1, 2, or maximum 3% of their total account value at any one time. So for example, if you have $100 in your account, the maximum you are going to be trading with at any one time is $3. And yes, I know that seems small, and I know that making profit on $3 seems quite insignificant. But if you can manage to stick to trading very small percentages of your account, you will be surprised at how quickly you can compound your money whilst also minimizing your losses. Third most common mistake that I see from beginner crypto traders is reacting emotionally to what's happening in the markets. And this generally manifests itself in the way of fear and greed in your emotions. Now, when we're feeling fearful, we are feeling like we're going to potentially lose money. And when you're in a trade as a brand new crypto trader, it can be really common to be fearful that you're going to lose your money. And quite often what I see is that beginner crypto traders will enter a trade and it will go up into profit by 10, 15, 20%, or maybe even more. And then what they do is they close the trade probably a little bit too early because they are fearful of losing out on that trade. And quite often, the trade will go up much, much higher, and potentially they could have made more profits. So fear can definitely be one that cuts you off at the knees in terms of you being able to compound your account just that little bit quicker. And then on the other hand, we also have reacting with greed, where if you have a few wins in a row and you see that you are making money, people start to get greedy and they start to over leverage trades. They start to add more than 1, 2, or 3% into their trades, and they open up multiple trades all at once in that sort of greedy lust for more money. And it is absolutely a recipe for disaster and to be avoided at all costs. Number 4 is poor risk management or no risk management. Now, I am huge on protecting your investment and protecting your capital. So there's a number of ways in which we do this, of which I've already touched on not over leveraging and over margining your account. But one of the most important things is making sure that you know your risk to reward ratio. So how much are you willing to lose in order to gain a certain amount? And if you're not comfortable in losing that certain amount, then you need to make sure that you have got a stop loss in place to protect your capital. And sometimes we do lose trades. Stop losses are normal, and getting stopped out is a common occurrence, especially as a beginner trader. But stop losses are a good thing because they prevent you from losing all of your money. And when they're employed with the right risk to reward ratio tactics, then what you'll find is that over time, your stop losses will become less and less, and you will become more profitable. And finally, number 5, the last but also one of the most common mistakes that I see from new crypto traders is a lack of analysis from both a fundamental and a technical point of view. So firstly, if we're looking to buy into a coin for a spot hold or a longer term investment, then it's vital that we research that coin and find out exactly what it is. What is its purpose? What is its use case? Who are the team behind it? What is the total supply of tokens or coins in the market? And how does it work? What's their roadmap moving forward? These are just some of the questions that you should be asking when you are researching into a coin that you want to invest into long term. Because ultimately in the crypto market, there are some coins which will be here in 10 years time, and there will some that will be gone. So you want to make sure that you are not investing in the wrong coins. And when it comes to technical analysis, this is pertinent when it comes to futures trading. If you haven't learned how to properly chart up a coin to be able to make decisions about when you're going to enter and exit a trade, then it's more than likely that you should not be entering that trade at all. Technical analysis is an absolute must. So there you have it. They're the top 5 beginner crypto mistakes that I see all the time. And hopefully now that you've seen them, you'll be able to avoid them from this point forward.